There are 3 words that can build a fortune. I don't know. And there are 3 words that can destroy one. Margin is poison. We are going to spend the next few hours together exploring the profound, life-altering wisdom contained in that second phrase, a phrase that forms the absolute bedrock of Warren Buffett's entire philosophy. He has said, with the chilling clarity of a man who has witnessed financial carnage up close, that if you're smart, you don't need it, and if you're dumb, you have no business using it. Leverage, the act of borrowing money to invest, is the only thing he has ever seen take truly intelligent people to zero. Not bad ideas, not bad timing, not bad luck. Leverage. It is the one trap that, once sprung, offers no escape. It transforms a temporary market decline, which is a certainty, into a permanent personal catastrophe, which is a choice. Today, you are going to learn how to never, ever make that choice. This is not a lesson about getting rich quick. It is the single most important lesson you will ever receive on how not to die poor. This is the final promise of a sound financial life, survival above all else, because only the survivors get to see the 8th wonder of the world, the miracle of compounding, play out to its glorious conclusion. We begin with the most seductive lie in all of finance, the siren song that has lured countless ships onto the rocks of financial ruin, the illusion of speed. Why are intelligent, rational people so irresistibly drawn to the poison of leverage? It's because leverage doesn't whisper about risk, it screams about opportunity. It promises to compress time, to take the long, patient road of wealth creation and turn it into a thrilling, high-speed expressway. It offers a shortcut to the destination everyone craves, financial freedom. And this temptation is not a modern phenomenon. It is a timeless human failing, one that Warren Buffett understood intimately, even in the earliest days of his career. To truly grasp this, we must travel back to the mid-1950s to Omaha, Nebraska. A young Warren Buffett, not yet 30 years old, is running a series of investment partnerships from a small office in his home. He is a local phenomenon, a financial prodigy managing the money of his family, friends, and a small circle of sophisticated local businessmen. His returns are extraordinary, consistently crushing the Dow Jones Industrial Average, but for some of his partners, it wasn't enough. They were living through the post-war boom, a time of seemingly endless prosperity. The market was roaring, and the mood was euphoric. They saw the fortunes being made around them. Fortunes built not just on smart stock picking, but on borrowed money. They would come to Buffett, men he respected, intelligent doctors and lawyers, and they would ask him a simple question. Warren, your returns are fantastic. But couldn't we make them even better? Why don't we use a little bit of leverage? Why don't we borrow against our portfolio to buy more of these wonderful businesses you're finding? They saw it as simple math. If he could generate a 25% return on their capital, then borrowing money at 5% to invest alongside their capital would amplify those returns dramatically. It was in their minds a no-brainer, a way to pour gasoline on an already raging fire of success. Buffett's response was always the same, a polite but absolute and unyielding no. He would sit them down and explain his reasoning, not with complex formulas, but with a simple, powerful logic. He told them that he could not and would not ever expose them to the risk of ruin. He explained that while leverage could indeed make them richer faster, it also introduced a small but non-zero probability of a catastrophic loss. And for him, any risk of total wipeout, no matter how small, was unacceptable. He was not in the business of getting rich fast. He was in the business of getting rich for sure. This anecdote is foundational because it reveals that Buffett's aversion to leverage isn't a rule he adopted after seeing some spectacular flameout. It was encoded in his financial DNA from the very beginning. He understood, intuitively, that the game of investing is not about maximizing one-year returns. It is about maximizing your portfolio's value at the end of your life. And the single biggest threat to that long-term goal is being knocked out of the game entirely. He knew that markets are cyclical and that periods of panic are inevitable. He knew a day would come when the tide would go out, and only then would you discover who's been swimming naked. He was determined that his partners, his investors, would always be wearing their swim trunks, financially speaking. He was willing to sacrifice the potential for faster gains, to endure the taunts of those who were getting richer quicker in the short term in exchange for the certainty of long-term survival and success. This early discipline, this steadfast refusal to bow to the pressure for more speed, laid the groundwork for the entire Berkshire Hathaway empire. It was a commitment to capital preservation that defined his investment style and separated him from the speculators and gamblers who littered the financial landscape. The psychological engine driving this lust for leverage is a potent cocktail of cognitive biases, a perfect storm of flawed mental wiring that makes borrowing to invest seem not just attractive, but logical. The first and most powerful ingredient is the overconfidence bias. Intelligent people, especially those successful in their own fields like the doctors and lawyers in Buffett's early partnerships, tend to overestimate their own abilities. They believe their intelligence in one domain translates to intelligence in all domains. They think, I am a successful surgeon, therefore I can successfully manage the risks of margin trading. They fail to appreciate that the stock market is a unique arena, one where high intelligence can sometimes be a disadvantage if it's not paired with profound emotional discipline. They believe they can outsmart the risk, that they'll know when to get out, that the catastrophic scenario simply won't happen to them. This is amplified by a second bias, the availability heuristic. Our brains give more weight to recent, dramatic, and easily recalled information. In a bull market, the stories we hear are of people who made a fortune using leverage. We see the headlines, the social media posts, of people who bought a speculative stock on margin and doubled their money in a month. These stories are available, they are vivid, and they create a distorted perception of reality. The countless stories of people who were quietly and completely wiped out by a margin call don't make the news. They are silent, invisible failures, and so our brain, working with the available evidence, concludes that the upside is common and the downside is rare. This creates a feedback loop of dangerous thinking. The third component is social proof, the deeply ingrained human tendency to assume that the actions of others reflect the correct behavior in a given situation. When it seems like everyone is using leverage to get rich, friends, colleagues, financial gurus on television, it creates immense psychological pressure to do the same. The fear of missing out, or FOMO, becomes overwhelming. It starts to feel foolish to be the only one sitting on the sidelines, patiently compounding, while others are seemingly lapping you on the racetrack of wealth. These three biases, overconfidence, availability, and social proof, combine to create a powerful narrative that leverage is a sophisticated tool for smart, aggressive investors who want to win big. It frames the debate incorrectly. It makes the cautious, unleveraged investor seem timid and unsophisticated, rather than prudent and wise. Buffett's genius was in recognizing this psychological trap for what it was. He built his entire framework of risk management around protecting himself and his investors from their own worst instincts. His refusal to use leverage was not just a financial decision. It was a psychological defense mechanism, a pre-commitment to a rational course of action that would shield him from the irrational euphoria of the crowd. He understood that in the heat of a roaring bull market, willpower is not enough. You need unbreakable rules. So how do we translate this understanding into a practical tool, a mental model that we can apply in our own financial lives to resist the siren call of leverage? We can call it the antidote to greed protocol. This is not a complex financial calculation. It is a simple, three-step checklist to run through whenever you feel the urge to speed up your returns through borrowing. It's a circuit breaker for your own investor psychology. Step 1 is to explicitly define your finish line. Most people chase more money without ever defining what enough looks like. Take out a piece of paper or open a spreadsheet and calculate the actual amount of capital you would need to be financially independent. Be specific. What annual income do you need? Using a safe withdrawal rate, like 4%, what is the total portfolio value that generates that income? This number, this specific dollar amount, is your financial finish line. The act of defining it changes the game. It's no longer an abstract race for more. It's a calculated journey to a tangible destination. Once you have that number, you can see with mathematical clarity that achieving it is simply a matter of time and consistent, reasonable returns. You will realize that the miracle of long-term investing and compounding will almost certainly get you there. You don't need to take existential risks. Step 2 is to conduct a social media and envy audit. For 1 week, pay conscious attention to your financial information diet. What are you reading? Who are you listening to? Are you following accounts that celebrate high-risk, leveraged speculation? Are you consuming content that triggers feelings of envy and inadequacy, that makes you feel like you're falling behind? You must ruthlessly curate your environment. Unfollow the gamblers. Mute the braggarts. Stop consuming content that fuels your worst impulses. Replace it with sources that champion prudence, patience, and long-term investing. This isn't about censorship. It's about controlling the inputs that shape your desires and decisions. You cannot maintain financial discipline if you are bathing your brain in a constant stream of get-rich-quick propaganda. Step 3 is to write your own financial obituary. This sounds morbid, but it is an incredibly powerful exercise in perspective. Imagine you are at the end of your life. What would you regret more? Would you regret not getting rich as fast as your neighbor who took a huge risk and got lucky? Or would you regret taking a foolish gamble with money that was essential for your family's security and losing it all, forcing you to spend your final decades in a state of financial stress and dependency? By framing the decision in terms of potential regret, you tap into a much more powerful emotional driver than greed. The fear of catastrophic failure and letting down the people you love is a far better guide for risk management than the desire for a slightly faster path to wealth. By running through this 3-step protocol, defining your finish line, auditing your inputs, and contemplating your regrets, you shift your entire mental framework. You move from a mindset of, how can I get more faster, to, how can I guarantee that I reach my goal without blowing up? It transforms leverage from a tempting tool into an obvious and unnecessary threat to your well-defined life plan. Now let's examine the opposite path, the well-trodden road that 99% of people take, often without even realizing the danger they're in. The path of the 99% is not just about using margin accounts for stock trading. It's about a cultural glorification of debt as a whole. It's the belief that leverage is a sign of financial sophistication, a tool that separates the players from the spectators. You see it everywhere. The real estate guru on a late-night infomercial telling you to use other people's money to buy dozens of properties with no money down. This is pure, unadulterated leverage. The financial advisor encouraging a client to take out a home equity line of credit, a HELOC, to invest in the stock market, effectively putting their family home on the line for the chance at a few extra percentage points of return. The crypto forums where anonymous users post screenshots of their 100x leveraged positions, celebrating massive gains while conveniently never posting the inevitable liquidations that wipe them out. This cultural narrative is incredibly dangerous because it masks the true nature of the risk. It's a masterclass in salesmanship, focusing exclusively on the potential upside while minimizing or completely ignoring the catastrophic downside. The 99% fall for this narrative because they are playing a different game. They are focused on their income statement, how much money they can make this month, this year. Buffett is focused on the balance sheet, the resilience and strength of his capital base over decades. They changed their house margin requirements to 40% due to volatility. Now he needs $33.048 in equity, but he only has $30.120. He gets the email, the one that makes your blood run cold. The subject line, margin call. He has to deposit more cash, or they will start liquidating his positions. He has no more cash. So the broker begins to sell his shares. And they don't ask him which ones to sell. They sell whatever is most liquid, at the worst possible price, in the middle of a panic. This forced selling pushes the stock prices down further, triggering more margin calls for other investors in a vicious downward spiral. By the time they are done selling to cover his loan, his entire starting capital is gone. He is at zero. Investor A, with her $72,000, is bruised but not broken. When the market eventually recovers, her portfolio will recover with it. Investor B is out of the game. Forever. That is the direct financial connection. Leverage turns a recoverable downturn into an irreversible catastrophe. It takes the power of decision away from you at the very moment you need it most. It is the financial equivalent of playing Russian roulette. You might win 5 times in a row, but you only have to lose once. We now move to the heart of the darkness, the mechanical instrument of financial execution itself, the margin call. To truly understand Buffett's visceral hatred of leverage, we must dissect this mechanism, not as an abstract concept, but as the terrifying, wealth-destroying event that it is. It is the financial guillotine, swift, impersonal, and final. The most vivid illustration of this principle in action, a story that should be taught in every business school and seared into the mind of every investor, is the spectacular collapse of long-term capital management in 1998. This was not a story of foolish amateurs getting in over their heads. This was a story of the supposed masters of the universe, the high priests of finance, being brought to their knees by the very tool they believed they had mastered, leverage. LTCM was a hedge fund founded in 1994 by John Meriwether, the legendary former head of bond trading at Salomon Brothers, and it included on its board 2 Nobel Prize-winning economists, Myron Scholes and Robert C. Merton, the intellectual fathers of the modern options pricing model. Their brainpower was off the charts. They were the smartest guys in any room they walked into. Their strategy was to use complex computer models to find tiny pricing discrepancies in global bond markets, so-called arbitrage opportunities. A typical trade might involve buying a slightly underpriced bond and selling a slightly overpriced but very similar bond. The profit on any single trade was minuscule, fractions of a penny on the dollar. So to make this strategy worthwhile, they had to do it on an enormous scale. And the only way to do that was with leverage. Extreme, mind-boggling leverage. For every $1 of their own capital, they borrowed and controlled over $25. At its peak, the fund had about $4.7 billion in capital, but it controlled over $125 billion in assets, and its derivatives book had a notional value of over $1.25 trillion. For a few years, it was a money-printing machine. They generated annual returns of over 40%, post-fees. They were hailed as geniuses. Their incredible success seemed to validate the idea that leverage, in the hands of brilliant people with sophisticated risk management models, was not a poison but a powerful engine of wealth. Then, in August 1998, the unthinkable happened. Russia defaulted on its domestic debt. This was a black swan event, something their models, based on historical data, had deemed virtually impossible. The event triggered a global flight to safety. Investors around the world dumped all but the most secure government bonds and fled to U.S. Treasuries. This caused the tiny pricing discrepancies that LTCM was betting on to converge, to suddenly diverge violently. All of their carefully constructed positions started bleeding money all at once. The smartest guys in the room were trapped. The problem with their strategy was that it required liquid markets to unwind their positions. But in a global panic, liquidity vanishes. They couldn't sell what they needed to sell, and as their losses mounted, their prime brokers, the big Wall Street banks that had lent them billions, began to get nervous. They started making the calls, margin calls. They demanded more collateral to back the loans. LTCM was forced to start selling assets into a market with no buyers, driving prices down even further, which in turn triggered even more margin calls from their other lenders. It was a death spiral. In the space of a few weeks, the fund lost $4.6 billion, virtually all of its capital. It was on the brink of a complete collapse that threatened to take the entire global financial system down with it, as its counterparties, the biggest banks in the world, faced massive losses. The Federal Reserve Bank of New York was forced to intervene, orchestrating a $3.6 billion bailout by a consortium of Wall Street banks. And who was one of the people they called, looking for a potential solution? Warren Buffett. He, along with others, was asked to consider taking over the fund's portfolio. He reviewed their positions, a tangled web of 60,000 trades, and was horrified by the sheer insane level of risk they had taken. He ultimately decided not to participate in the bailout in the form proposed, but the lesson was seared into his mind. Here you had men with IQs of 170, Nobel laureates in economics, who had managed to go broke. Why? Because they took a strategy that worked 99% of the time and leveraged it to the hilt, completely ignoring the catastrophic consequences of the 1% event. They flew a brilliant airplane but with no ability to withstand a storm. They failed to understand a simple truth that any Omaha farmer could have told them. No matter how smart you are, you can't predict the rain. You have to build your barn to withstand the hurricane. The psychological experience of a margin call is a descent into a specific kind of hell, and understanding the cognitive biases at play is crucial for building our immunity. The primary force at work is an extreme manifestation of loss aversion. This is the principle, demonstrated by psychologists Daniel Kahneman and Amos Tversky, that the pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. A margin call is not just a loss, it's a loss that compounds with a feeling of powerlessness. You are not choosing to sell, you are being forced to sell. This takes away your agency, your control, which is a profound psychological blow. It triggers a state of panic, what is often called an amygdala hijack. The amygdala is the ancient part of our brain responsible for the fight-or-flight response. When faced with an existential threat, and a margin call feels like financial death, the amygdala floods the body with cortisol and adrenaline. Your heart rate increases, your breathing becomes shallow, and the blood flow is diverted from your prefrontal cortex, the rational thinking part of your brain, to your limbs. In this state, you are physiologically incapable of making calm, logical decisions. You are a cornered animal. This is why people in the midst of a margin call do irrational things. They sell their best long-term holdings, the family jewels, just to raise cash quickly instead of selling their more speculative, lower-quality assets. They double down, depositing more money they can't afford to lose in a desperate gamble to avoid crystallizing the loss. This is driven by another powerful bias, regret aversion. The act of selling a great company like Apple or Google at a 50% loss because of a margin call feels infinitely worse than simply watching it go down and then recover. The forced sale makes the loss permanent and personal. It becomes a story you tell yourself for the rest of your life. I had to sell my best stock at the absolute bottom. The potential for this future regret is so painful that people will do anything to avoid it, often making their situation even worse. This combination, the amplified pain of loss aversion, the physiological panic of an amygdala hijack, and the desperate avoidance of future regret, is what makes a margin call so devastating. It attacks you on every level, financially, emotionally, and neurologically. It is a perfect storm of negative psychological forces. Buffett's rule to never use leverage is a preemptive defense against this storm. He knows that no amount of intelligence or willpower can reliably overcome the raw, primal fear of a margin call. The only way to win this particular game is not to play. By refusing to borrow, you ensure that you will never have your decision-making power stripped away from you. You ensure that you, and only you, will decide when to buy and when to sell. You retain your agency, your rationality, and your ability to act as a calm, intelligent investor, especially when others are losing their minds. This is the ultimate competitive advantage. To make this visceral and to build the necessary psychological armor, we need an applied mental model. Let's call it the margin call fire drill. This is a thought experiment that you should conduct regularly, perhaps once a quarter, to stress test your own portfolio and your own emotional fortitude. It costs nothing, but it could save you everything. Here is the step-by-step process. First, open up your brokerage statement or portfolio tracker. Look at the total value. Now, in your mind, cut that number in half. Imagine you wake up tomorrow morning and, due to some unforeseen global event, a new pandemic, a major war, a financial crisis, the market has crashed by 50%. Take a moment and really feel that. Don't just see the number. Feel the emotional punch in the gut. That feeling of shock and fear is what we are trying to inoculate you against. Second, go through your portfolio, line by line, and ask yourself a critical question. Is there any position here that is not 100% mine? Do I have any margin loans? Have I sold any uncovered options? Is there any form of leverage, however small or seemingly insignificant, in my financial life? If the answer is yes, you have found a ticking time bomb. Now you must simulate the explosion. Calculate exactly what would happen with a 50% drop. Would you receive a margin call? How much cash would you need to deposit? If you don't have the cash, what would your broker be forced to sell? Be brutally honest with yourself. This is the part of the fire drill where you feel the simulated heat. Third, and this is the most important step, you must simulate the loss of agency. Imagine your broker sells your highest quality, long-term holding to meet the margin call. They sell your shares in that wonderful business you plan to hold for decades, the one that forms the core of your retirement plan. They sell it at a price that is 50% lower than it was yesterday. Feel the rage, the helplessness, the profound sense of violation. This is the true cost of leverage. It's not just the money, it's the theft of your financial future by a clause in some fine print you probably never read. By running this fire drill, you are doing what pilots do in a flight simulator. You are experiencing the catastrophe in a safe environment, so that you can learn the lessons without suffering the real-world consequences. The primary lesson of the margin call fire drill is always the same. The only way to survive the crash is to ensure you are flying a plane with no structural weaknesses before you ever take off. It will force you to deleverage your financial life, to pay down or eliminate any margin loans, and to build a portfolio that you can own, comfortably and without fear, through even the most violent market storms. It transforms risk management from an abstract idea into a felt reality. Now let's look at the antithesis, the path taken by the 99% who fall into this trap. Their journey to ruin often begins with a complete and willful ignorance of the fine print. When you open a brokerage account, you are presented with a mountain of legal documents. Somewhere in that mountain is the margin agreement. Most people scroll to the bottom and click "I agree" without reading a single word. They don't realize that in that document they are signing away fundamental rights. They are agreeing that the securities in their account can be lent out by the brokerage. More importantly, they are agreeing that the brokerage has the right to liquidate their assets, without their consent, at any time for any reason, to satisfy a margin debt. They operate under the dangerous illusion that they are in control. Another common mistake is the belief in safe leverage. People will hear about something like portfolio margin, which allows for higher leverage levels for supposedly diversified portfolios, and they believe this is a more sophisticated and safer way to borrow. They don't understand that it is simply a bigger shovel to dig a deeper hole. The models that deem their portfolio diversified are based on historical correlations, and in a true market panic, all correlations go to 1. Everything goes down at once, and that safe portfolio margin evaporates in an instant, leading to an even more devastating margin call. The 99% also suffer from a failure of imagination. They cannot truly conceive of a 50% market drop because it hasn't happened recently. They look at the last 5 or 10 years of relatively calm markets and extrapolate that into the future, a classic psychological error. They forget the lessons of 2008, of 2000, of 1987, of 1973, of 1929. They believe it's different this time, the 4 most expensive words in the English language. They fail to appreciate that market crashes are not an anomaly. They are a regular, recurring feature of the economic landscape. The final mistake, and perhaps the most tragic, is what happens after they get the margin call. Instead of recognizing it as a fatal blow, many view it as a problem to be solved. They scramble for cash, they sell other assets, they borrow from family, they take a cash advance on a credit card, they throw good money after bad in a desperate attempt to keep the leveraged position alive, believing it will surely bounce back. They are like a poker player on a losing streak, convinced the next hand will be the one that saves them. But the market can remain irrational far longer than they can remain solvent. They end up not just losing their investment capital, but destroying their entire financial life, piling new debts on top of the old, all because they could not accept the simple, brutal truth that the game was over. This is the path of the 99%. Ignorance of the rules, a misplaced belief in safe leverage, a failure to imagine the worst-case scenario, and a desperate, irrational response to the inevitable crisis. The financial connection of a margin call is the mathematical certainty of asymmetric destruction. Let's make this painfully clear with a concrete case study. Imagine an investor, let's call him Tom. Tom has a portfolio worth $200,000. It's his life savings. He's been investing for 15 years. He feels he knows what he's doing. But he's impatient. He wants to accelerate his journey to retirement. He decides to use margin. He borrows $100,000 from his broker, bringing his total invested assets to $300,000. He is now leveraged 1.5 to 1 on his own capital. The market has been good, and he feels confident. Then, a bear market begins. Over the next 6 months, the market grinds down by 33%, a significant but not historic decline. Let's look at the numbers. His $300,000 portfolio is now worth $200,000. He still owes the broker the $100,000 he borrowed, plus interest. Let's ignore the interest to keep it simple. So his personal equity in the account has gone from $200,000 down to $100,000. A 33% drop in the market has resulted in a 50% drop in his personal capital. This is the painful math of leverage on the way down. But now the brokerage's risk department steps in. Their rules state that the loan cannot exceed 50% of the portfolio's value. His loan is $100,000, and his portfolio is now worth $200,000. He's right at the limit. He gets a warning. The next day, the market opens down another 5%. His portfolio drops to $190,000. His $100,000 loan is now more than 50% of the portfolio's value. He gets the margin call. He must immediately pay down the loan to get it back under the 50% threshold. He needs to reduce his loan to $95,000, which means he needs to come up with $5,000 in cash. He doesn't have it. So the broker sells $10,000 worth of his stock to pay down the loan and create a small buffer. This forced sale happens at the worst possible time, locking in a massive loss on that portion of his portfolio. Now compare this to another investor, Sarah. She also started with $200,000. She used no leverage. When the market dropped 33%, her portfolio fell to $134,000. She's down $66,000 on paper. It hurts. But she has no margin call. She is under no pressure to sell. She can wait. She can even choose to buy more at these depressed prices if she has extra cash. Now let's fast forward 2 years. The market has recovered and gone on to new highs. It's up 60% from the bottom. Sarah's portfolio, which had fallen to $134,000, is now worth over $214,000. She has recovered all her losses and is now ahead. What about Tom? His portfolio was at $190,000 before the forced liquidation of $10,000. So he was left with $180,000 in the market. That portfolio also grows by 60%. It's now worth $288,000. From this, we have to subtract the remaining $95,000 he owes the broker. His net equity is $193,000. He is still down $7,000 from where he started, while Sarah is up $14,000. The leverage didn't just cause him pain, it permanently impaired his capital base, ensuring that he would underperform in the recovery. He was forced to sell a piece of his asset base at the point of maximum pessimism, a sin for which the market shows no mercy. This is the direct, quantifiable financial impact. It is a permanent handicap on your wealth-building journey, a self-inflicted wound that never fully heals. This brings us to a deeper, more philosophical principle, the asymmetry of risk. This is the hidden truth that the leveraged speculators always miss. They look at a bet and see a 50% chance of doubling their money and a 50% chance of losing it all, and some might think that's a fair bet. Buffett looks at that and sees lunacy. Why? Because the outcomes are not symmetrical. If you double your money, you are better off. But if you lose it all, you are out of the game. You don't get to come back to the table. The pain of ruin is infinitely greater than the pleasure of any finite game. This is a concept that a brilliant thinker, Nassim Nicholas Taleb, has explored in depth. He calls it the problem of ergodicity. In a non-ergodic system, the average outcome of a group is not the same as the average outcome for an individual over time. Imagine 100 people go to a casino. Each bets their entire net worth on a single coin flip. About 50 of them will double their money, and about 50 will go bankrupt. The average outcome for the group is a handsome profit. But if you are a single individual playing that game sequentially, you are guaranteed to go bankrupt eventually. The stock market, when leverage is introduced, becomes a non-ergodic system. A single event, a single margin call can lead to ruin, and from ruin, there is no recovery. Buffett's entire career can be viewed as an exercise in ensuring he always operates in an ergodic system, one where he can survive any single event to play another day. A perfect anecdote to illustrate this is not one of failure, but one of stunning success born from avoiding this very trap. Let's go to the depths of the 1973-1974 bear market. It was a brutal period. The market fell by nearly 50%. Inflation was rampant, the economy was in a recession, and the mood was bleak. It was a time of maximum pessimism. Most investors were either panicking or being forced to sell because of leverage. Their portfolios were decimated. But Warren Buffett, at the helm of Berkshire Hathaway, was calm. He had no debt. In fact, he had a growing pile of cash from Berkshire's insurance operations. For him, the crash was not a crisis. It was an opportunity. While others were being carried out on stretchers, he was calmly walking through the battlefield, picking up incredible bargains. His most famous investment from this period was the Washington Post Company. The Post was a wonderful business, with a powerful media franchise and a virtual monopoly in its market. But in the depths of the bear market, its stock had been crushed, along with everything else. The entire company had a market capitalization of around $80 million. Buffett did his homework. He realized that the company's assets, if sold off individually, were worth at least $400 million. You could buy the whole company for $80 million and immediately liquidate it for 5 times that amount. It was an absurdity, a classic cigar butt investment, but with a world-class business attached. So between 1973 and 1974, Buffett started buying. He invested about $10.6 million, acquiring a significant stake in the company. He wasn't using leverage. He was using cold hard cash that he had on hand, precisely because his conservative financial management had prepared him for such a moment. He didn't need the stock to go up the next day or the next month. He had staying power. That $10.6 million investment would become one of the most successful in history. Over the next 3 decades, as the Post thrived, that stake would grow to be worth over $1.2 billion, a return of more than 100 times his initial investment. This story is the perfect illustration of asymmetric risk. The downside for Buffett was limited. The business was so cheap that it was hard to imagine losing much money. The upside, however, was enormous, but the key to the whole story is that he was only able to make this investment because he had avoided leverage. While the 99% were being wiped out by margin calls, forced to sell their best assets at fire sale prices, Buffett was the buyer on the other side of the trade. He was exploiting the asymmetry created by their folly. His capital preservation strategy was not just a defensive measure. It was the foundation of his offensive strategy. By avoiding the small chance of ruin, he guaranteed himself the opportunity to capitalize on the certainty of future market panics. The underlying psychological principle at play here is a profound and often misunderstood cognitive bias known as probability neglect. When people are confronted with a high-stakes decision, they tend to focus on the magnitude of the outcome rather than its probability. The idea of doubling your money is so emotionally charged and exciting that the brain effectively ignores the small but real probability of total loss. We are not wired to be intuitive statisticians, especially when our emotions are involved. We overweight the vivid, positive outcome, getting rich quick, and underweight the abstract, negative outcome, going to zero. This is why lottery tickets are a multi-billion-dollar industry. The probability of winning is infinitesimal, but people don't focus on the probability. They focus on the life-changing jackpot. Leveraged trading is, for many, a form of lottery ticket. It offers that same tantalizing possibility of a massive, rapid payout, and that possibility is so alluring that it overrides the rational assessment of the risks involved. The second, more subtle principle is the one we touched on earlier, the confusion over ergodicity. This is a critical mental model for any long-term investor. Most financial theories are built on ensemble probabilities, what happens to a large group of people at one point in time. But as an individual, you live in time probability, what happens to you over a long period. If there is any chance of an absorbing barrier, an outcome from which you cannot recover, like death or financial ruin, the two concepts are completely different. Your personal strategy must be optimized for survival over time, not for the average outcome of a theoretical group. Buffett understands this at a gut level. He is not trying to maximize Berkshire's return in any single year. He is trying to ensure that Berkshire will still be around and thriving in 50 years. This requires a ruthless focus on avoiding any action that could lead to ruin, even if that action has a high probability of a positive expected return. This is why he insists on such a large cash position and why he is so allergic to debt at the parent company level. He is building a system that is robust, resilient, and anti-fragile. It is designed to survive the black swan event and to profit from the ensuing chaos. Most investors, by using leverage, are doing the opposite. They are building fragile systems optimized for calm weather that are guaranteed to shatter in the first major storm. They are making a bet that the storm will never come, a bet that has been lost by every single person who has made it throughout history. To put this into practice, we need a mental model, a blueprint for decision-making. Let's call it the ruin probability audit. For any significant financial decision you are considering, you must stop asking, "What is my potential return?" and start asking a different, far more important question. What is the probability that this decision could lead to my financial ruin? This audit has 3 parts. Part 1. Identify the absorbing barrier. In the context of leverage, the absorbing barrier is the margin call. It is the point of no return. But other decisions have them too. Starting a business with all of your life savings and taking on personal guarantees for its debt could have an absorbing barrier of personal bankruptcy. Investing your entire retirement fund in a single, speculative, illiquid asset has an absorbing barrier. You must be able to clearly identify the mechanism by which you could be forced out of the game. If you cannot identify one, the risk is likely manageable. If you can, you must treat it with extreme caution. Part 2. Stress test the probability. Do not rely on your gut feeling or on what happened in the last few years. You must actively seek out the historical worst-case scenarios. If you are using margin, look at what would have happened to your position in 1987, in 2000, in 2008. If the strategy would have resulted in a margin call in any of those historical scenarios, you must assume that it can and will happen again. You must assume the impossible 1-in-100-year storm will happen next year. As the saying goes, whatever can go wrong will go wrong. In finance, this is a law, not a suggestion. Part 3. The Munger Test. Charlie Munger has a great mental model. He says, "All I want to know is where I'm going to die, so I'll never go there." Apply this to your financial decision. If you have identified a plausible path to ruin, no matter how remote it seems, the decision is simple: don't go there. It doesn't matter how high the potential upside is. If there is a non-zero chance of total, irreversible loss of your essential capital, the bet is off the table, period. This is not about being timid. It's about being a professional. Professional pilots don't take unnecessary risks with their planes. Professional surgeons don't take unnecessary risks with their patients. Professional investors must not take unnecessary risks with their capital. By running every major decision through the ruin probability audit, you fundamentally change your relationship with risk. You move from being a speculator chasing returns to being a strategic manager of capital, focused on long-term survival and prosperity. You start to see leverage not as a tool for wealth creation, but as a foolish and amateurish invitation to disaster. The antithesis to this professional approach is the path of the 99% who consistently chase lottery tickets. They are perpetually focused on the potential upside, the life-changing win, while remaining blissfully, willfully ignorant of the downside. We see this behavior in every market bubble. During the dot-com boom, it was people quitting their jobs to day trade internet stocks on margin. They saw their neighbors getting rich and thought they could do it too. They focused on the story of the one person who turned $10,000 into $1 million, not the 99 people who turned $10,000 into zero. More recently, we saw it in the cryptocurrency mania. People took out mortgages on their homes to buy speculative digital tokens, often with names of dog breeds. They used offshore exchanges to get access to 100x leverage, allowing them to control $100,000 worth of a volatile asset with only $1,000 of their own money. They were not investing, they were gambling in its purest form. They were making an asymmetric bet, where their upside was capped. The price can only go so high. But their downside was a near certainty of total loss. This behavior extends beyond just financial markets. It's the mindset of the entrepreneur who takes on massive personal debt to fund a business idea without ever testing the market, convinced that their idea is the next big thing. It's the law student who takes on $300,000 in non-dischargeable debt to attend a third-tier school, focusing on the slim chance of making partner at a big law firm while ignoring the much higher probability of being stuck in a low-paying job with a crushing debt burden. The common thread is a failure to respect the asymmetry of risk. The 99% are playing a game where they have to be right all the time, and a single mistake can be fatal. Buffett and other professional investors play a game where they can be wrong many times, but they structure their affairs so that no single mistake can ever take them out of the game. This lottery ticket mindset is fueled by a media and culture that celebrates big wins and ignores the vast graveyard of failures. For every story of a successful startup founder, there are thousands of bankruptcies. For every crypto millionaire, there are legions of liquidated accounts. But the failures are silent. The winners get the interviews, the magazine covers, and the book deals. This creates a deeply skewed perception of reality, making the path of high-risk speculation seem far more attractive and far less dangerous than it truly is. The direct financial connection of understanding this asymmetry is the concept of anti-fragility. A fragile portfolio, one that uses leverage, breaks under stress. A robust portfolio survives stress, but an anti-fragile portfolio, the kind Buffett builds, actually gets stronger from stress and volatility. Let's quantify this. Imagine the 2008 financial crisis. The market is in freefall. Lehman Brothers has collapsed. Panic is in the air. The leveraged investor is being wiped out. They are forced to sell their assets to meet margin calls, realizing massive losses. Their financial net worth is shattered, and their ability to earn future returns is crippled. The unleveraged investor, who simply owned an index fund, is in pain. Their portfolio is down 40 to 50%, but they can hold on. Their earning power is intact. They will eventually recover. Now look at Buffett. He has spent years, decades, building a business with no parent company debt and a massive pile of cash. In 2007, before the crisis, many analysts criticized him for this. They said he was too conservative, that his cash drag was hurting Berkshire's returns. They said he should be using leverage, like the private equity firms, to juice his performance. Buffett ignored them. Then the crisis hit. And suddenly, his cash was not a liability, it was the most valuable asset in the world. While everyone else was desperate for capital, he was the one who had it. And he became the lender of last resort to the titans of American industry. In September 2008, he invested $5 billion in Goldman Sachs. In October, he invested $3 billion in General Electric. In 2011, he invested $5 billion in Bank of America. These were not common stock investments. He negotiated incredible terms, preferred stock paying massive dividends, 10% in the case of Goldman Sachs, plus warrants to buy common stock at ridiculously low prices in the future. He was able to demand these terms because he was the only one with the capital and the reputation to be a credible partner. He was not a seller in the panic. He was a buyer. He was not fragile. He was anti-fragile. The crisis, which destroyed so many, made Berkshire Hathaway stronger and more profitable. That $5 billion investment in Goldman Sachs earned Berkshire about $3.1 billion in dividends and stock buybacks over the next few years. The warrants gave them the right to buy Goldman stock at $115 a share. They exercised those rights when the stock was much higher, resulting in a profit of over $2 billion. The Bank of America deal was even more lucrative, netting Berkshire a profit of more than $12 billion. This is the ultimate financial connection. By religiously avoiding leverage, you do more than just survive the storm. You put yourself in a position to profit from it. You are able to buy the assets that the leveraged fools are forced to sell. You turn their financial ruin into your generational opportunity. That is the true power of rejecting the asymmetry of risk. This leads us to the constructive portion of our deep dive, the alternative to a life of leveraged anxiety. It is the philosophy of the fortress balance sheet, both for corporations and for individuals. This is the proactive, tangible strategy for building a financial life that is not just immune to market shocks, but is designed to thrive on them. It is the conscious decision to prioritize resilience over returns, knowing that in the long run, resilience is the single greatest driver of returns. Buffett's masterpiece is not any single investment. It is the design of Berkshire Hathaway itself. It is a corporate fortress. The core of this fortress is the massive and stable stream of cash flow from its wholly owned operating businesses, railroads, utilities, insurance companies, and manufacturers. This is the foundation. On top of this, you have the castle walls, the enormous portfolio of publicly traded stocks. But the most critical feature, the one that makes the fortress impregnable, is the moat filled with cash and U.S. Treasury bills. As of the end of 2023, Berkshire Hathaway held over $167 billion in cash and equivalents. This is an almost unimaginable sum of money. Wall Street analysts frequently complain about this cash pile. They call it unproductive. They argue that Buffett should be using it to buy back more stock or make another large acquisition. They see it as a drag on Berkshire's performance metrics. They are missing the point entirely. That cash is not an asset waiting to be deployed, it is the deployment. Its function is to ensure that Berkshire can withstand any conceivable financial storm. Buffett has said he will always run Berkshire with at least $30 billion in cash, a firewall that guarantees he will never be forced to sell assets at an inopportune time. But its purpose is also offensive. That $167 billion is dry powder. It is the capital that allows him to act with speed and decisiveness when opportunity arises, as it did in 2008. While other CEOs were desperately trying to secure credit lines to survive, Buffett was on the phone to Goldman Sachs, dictating the terms of their survival. The fortress balance sheet is what gives him his power. It is the source of his famous investment mantra: be fearful when others are greedy, and greedy when others are fearful. You can only afford to be greedy when others are fearful if you have the resources to act. The fortress provides those resources. This philosophy is not just for multi-billion-dollar conglomerates. It is a principle that must be applied to our personal financial lives. So how do we, as individuals, build our own personal fortress? This is the mental model we'll call the Personal Fortress Protocol. It's a blueprint for structuring your own balance sheet to maximize resilience and opportunity. It has 4 essential components. The first component is the emergency moat. This is your cash reserve. The standard advice is 3 to 6 months of living expenses. This is a good start, but for a true fortress, you should aim higher, especially if your income is variable. This money should be held in the most boring, safest, most liquid accounts possible, a high-yield savings account or short-term treasury bills. This is not an investment, it is insurance. It is insurance against a job loss, a medical emergency, or any unexpected life event that could otherwise force you to sell your long-term investments or go into high-interest debt. The emergency moat is what allows you to sleep at night, knowing that a short-term crisis will not become a long-term catastrophe. The second component is the debt-free citadel. You must make a clear distinction between productive and destructive debt. A low-interest fixed-rate mortgage on a home you can comfortably afford can be a productive asset. But high-interest consumer debt, credit cards, personal loans, car loans, is a cancer on your balance sheet. It is the enemy of financial freedom. Building your fortress requires a systematic and ruthless plan to eliminate all destructive debt. Every dollar you send to a credit card company is a dollar that could be reinforcing your own walls. Being completely free of consumer debt is one of the most powerful positions you can be in. It dramatically lowers your baseline cost of living, which in turn increases your savings rate and reduces your vulnerability to income shocks. The third component is the investment keep. This is your portfolio of long-term assets, like stocks and real estate. The crucial rule for the keep is that it must be sacrosanct. You never, ever borrow against it. You never use it as collateral. You view this capital as being on a one-way journey into the future, compounding quietly for decades. This is the engine of your long-term wealth creation, and you must protect it from the short-term temptations and crises of your daily life. The fourth and final component is the opportunity fund. This is the personal equivalent of Buffett's massive cash pile. Once your emergency moat is full and your consumer debt is gone, you can start building a separate cash or near-cash fund. This is not for emergencies. This is for opportunities. This is the cash you will use to buy more stocks when the market crashes 30%. This is the fund that allows you to be greedy when others are fearful. It may feel like a drag on your returns during a bull market. You will be tempted to invest it. You must resist. You must remember that its true return is not measured in interest earned, but in the price at which you are able to buy assets during a panic. By implementing the Personal Fortress Protocol, you are fundamentally changing your financial posture. You are moving from a fragile, vulnerable position to one of immense strength and resilience. You are no longer a potential victim of the next market downturn. You are a potential beneficiary. Let's examine the antithesis, the path of the 99%, which is to live in a financial house of cards. The foundation of this house is living paycheck to paycheck. A shocking number of people, even those with high incomes, have little to no cash buffer. They are one unexpected car repair or medical bill away from a financial crisis. Their entire financial life is balanced on a knife's edge. Instead of a moat of cash, they have a mountain of consumer debt. They use credit cards to fund a lifestyle they cannot afford, confusing the ability to borrow with actual wealth. They see their rising home value as a personal ATM, constantly refinancing or taking out HELOCs to pay for vacations, renovations, or even to cover basic living expenses. They are effectively destroying their home equity, their single largest asset, brick by brick. Their investment portfolio, if they have one, is often built on a shaky foundation. They might be contributing to a 401k, but then they take out a 401k loan to pay off a credit card, defeating the entire purpose of long-term saving. They are constantly robbing their future selves to pay for the mistakes of their present selves. This financial fragility creates a perpetual state of anxiety. They are always one step away from disaster. When a real crisis hits, like a job loss, They have no defenses. They are immediately forced into survival mode. They might have to sell their stocks at the bottom of the market, raid their retirement accounts, paying taxes and penalties, or default on their debts, destroying their credit for years to come. They have absolutely no capacity to take advantage of the opportunities that a crisis presents. The very idea of buying stocks during a crash is laughable to them. They are just trying to figure out how to pay their rent. This is the reality for the majority of households. They are not building a fortress. They are building a prison of their own financial decisions. The walls are made of debt, the bars are made of monthly payments, and the warden is the constant fear of an unexpected bill. This is the direct opposite of the freedom and power that comes from a fortress balance sheet. It is a life of perpetual vulnerability, a life where you are always at the mercy of external events rather than being the master of your own financial destiny. The direct financial connection of a fortress balance sheet is the monetization of resilience. Let's quantify the staggering advantage this provides. Consider two individuals, both 35 years old. Individual A has built a personal fortress. She has no consumer debt, a 6-month emergency fund, and an additional $50,000 in an opportunity fund held in T-bills. She also has a $200,000 stock portfolio. Individual B lives in a house of cards. He has $20,000 in credit card debt at 18% interest, no emergency fund, and a $200,000 stock portfolio. A severe recession hits and both individuals lose their jobs. The stock market falls by 40%. Individual B is in immediate crisis. He has no income and no cash. He has to start paying his bills with his credit cards, deepening his debt. After a few months, he is forced to sell some of his stocks to generate cash for living expenses. He sells $30,000 worth of stock from his portfolio, which has fallen in value to $120,000. He is selling at the absolute bottom, locking in huge losses. The stress is immense, and it hampers his ability to effectively search for a new job. Now look at individual A. When she loses her job, it's a serious problem, but it is not a catastrophe. Her emergency fund covers her living expenses. She does not have to touch her investment portfolio. In fact, she sees the 40% market drop for what it is, a once-in-a-decade buying opportunity. She takes her $50,000 opportunity fund and invests it in the stock market, buying shares at a massive discount. She is calm, confident, and can focus all her energy on finding a new, high-quality job. Let's fast forward 5 years. The economy and the market have recovered. Both have found new jobs. Individual B's portfolio, which he was forced to draw down, has recovered but is still lagging. He also has a larger debt burden from the crisis. His net worth has taken a permanent hit. Individual A's portfolio, however, has roared back. Her original $200,000, which fell to $120,000, is now worth well over $250,000. But the $50,000 she invested at the bottom has more than doubled to $110,000. Her decision to build a fortress and maintain an opportunity fund has directly generated an additional $60,000 in wealth. But the real difference is larger than that. Her resilience allowed her to make a better career decision, to negotiate a higher salary, and to continue her savings plan uninterrupted. The fortress balance sheet didn't just protect her from the downside, it created a massive, quantifiable upside. This is the financial payoff. Resilience isn't a passive defensive stance. It is an active, aggressive strategy that allows you to turn the market's greatest risks into your greatest opportunities. It is the financial alchemy of turning fear into fortune. This brings us to our final and most profound pillar. We have learned why leverage is poison, how it works, and how to build a fortress to protect ourselves. But protection alone is not the goal. The goal is to build wealth. And if we reject the false leverage of debt, what do we replace it with? The answer is the most powerful force in the universe, the leverage of time. This is the power of patience, the understanding that true, sustainable wealth is built, not in days or months, but over decades, through the slow, silent, unstoppable miracle of compounding. Buffett's entire strategy, his entire life, is a testament to this principle. He is not the world's greatest stock picker because he finds companies that will double in 6 months. He is the world's greatest investor because he finds wonderful businesses that he can own for 50 years. He understands that the real leverage is not financial, but temporal. A perfect illustration of this is his 1972 acquisition of See's Candies. At the time, Berkshire Hathaway was a very different company. It was still primarily a struggling textile business with an insurance operation attached. Buffett and Munger were looking for high-quality businesses to buy with the cash flow, the float, from their insurance operations. A man named Blue Chip Stamps, which Berkshire controlled, was presented with the opportunity to buy See's Candies, a beloved, family-owned chocolate company based in California. The asking price was $30 million. Buffett's initial analysis suggested the company was only worth about $25 million based on its tangible assets and earnings. His instinct was to pass. It was his partner, Charlie Munger, who pushed him. Munger saw something more. He saw a brand with immense customer loyalty, a moat that allowed it to raise prices year after year without losing business. He convinced Buffett that they should be willing to pay a premium for a truly wonderful business, rather than a mediocre price for a mediocre business. They negotiated and bought the company for $25 million in cash. There was no leverage. There was no complex financial engineering. It was a simple cash purchase of a great company. That $25 million investment has become the template for the entire Berkshire empire. See's Candies required very little additional capital investment over the years. It was a cash-generating machine. Since 1972, See's has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all of which was sent back to Omaha to be reinvested in other businesses and stocks. That initial $25 million investment has been returned 80 times over, and Berkshire still owns 100% of the company, which continues to produce tens of millions in cash every year. This is the power of compounding in its purest form. Imagine if instead of buying See's with cash, they had done a leveraged buyout, loading the company with debt. The pressure would have been to cut costs, raise prices too quickly, and sell the company in 5 to 7 years to pay back the loans. They would have made a decent profit, perhaps 2 or 3 times their money, but they would have killed the golden goose. They would have sacrificed a 50-year gusher of cash for a short-term gain. By avoiding leverage and exercising patience, they allowed the true value of the business to compound for decades. They understood that the highest returns don't come from financial engineering, but from owning a great business and letting it do its thing, year after year, decade after decade. This is the ultimate leverage: patient, long-term, uninterrupted compounding. The psychological principle that prevents us from harnessing this power is one of the most fundamental biases in the human brain: hyperbolic discounting. We have an innate, powerful preference for smaller, immediate rewards over larger, delayed rewards. This is the core of so much self-destructive financial behavior. It's why we choose the pleasure of a $1,000 purchase today over the much larger future value of investing that $1,000. It's the classic marshmallow test on a grand adult scale. The ability to delay gratification is not just a virtue, it is a financial superpower. Compounding's a backloaded process. The real magic doesn't happen in year 5 or year 10. It happens in year 30 and year 40 when the curve on the chart goes nearly vertical. But our brains are not equipped to intuitively grasp the power of exponential growth. We think linearly. We see the slow, boring progress in the early years and we get impatient. We think, this is taking too long. And that impatience is the open door through which the temptation of leverage walks in. Leverage promises to bend the curve of compounding, to give you the results of year 30 in year 5. It is a direct appeal to our hyperbolic discounting bias. It is a marshmallow, dipped in poison, offered to us right now. The discipline of long-term investing requires a conscious, deliberate effort to override this innate programming. It requires us to constantly project our minds into the future, to visualize the massive reward that awaits us if we can just stay the course. It requires a form of faith, not a blind faith, but a faith grounded in the mathematical certainty of compounding. Buffett's mind does this automatically. When he looks at a business like See's Candies, he's not just seeing its current earnings. He is running a movie in his head of what those earnings could look like in 10, 20, 50 years. He is living in the future. This ability to mentally transcend our innate impatience is the psychological foundation upon which all great long-term investment fortunes are built. It is the ability to say no to the tempting marshmallow today in exchange for the entire marshmallow factory tomorrow. To cultivate this superpower in ourselves, we can use a practical mental model, the compounding calculator meditation. This is not a mystical practice. It is a concrete exercise designed to rewire your brain's reward system. Here's how it works. Once a month, set aside 15 minutes. Open up a simple online compound interest calculator. First, input your current investment portfolio value. Then, input a conservative, realistic annual rate of return. Don't use 20%. Use 7% or 8%, the historical long-term average of the stock market after inflation. Then, input the number of years you have until retirement. 30 years, 40 years. Hit calculate. Now, look at that final number, stare at it, let it sink in. That is the mathematical destiny of your capital if you do just one thing: leave it alone. If you protect it from your own worst instincts, from the temptation of leverage, from the siren song of impatience. Now, start playing with the variables. Add in your expected annual contributions. See how that dramatically changes the final number. See what happens if you can increase your savings rate by just a few percentage points. The result is often staggering. Then, do the most important part of the meditation. Change the time variable. Look at the value after 10 years, then 20, then 30, then 40. You will see with your own eyes that the growth in the last 10 years is often more than the growth in the first 30 combined. This is the visual proof of the backloaded nature of compounding. This exercise does something profound to your brain. It makes the future reward tangible. It takes the abstract concept of your retirement nest egg and turns it into a specific awe-inspiring number. It connects your small, patient actions today, saving another dollar, avoiding a foolish risk, with a massive, concrete reward in the future. It trains your brain to get a dopamine hit not from spending, but from contemplating your future wealth. It is the antidote to hyperbolic discounting. It is a way to make the future feel as real and as rewarding as the present. By practicing this simple meditation regularly, you will find that your desire for the quick fix of leverage begins to fade. Why would you risk everything for a shortcut when the scenic route is mathematically guaranteed to lead to a paradise of wealth? The antithesis, the path of the 99%, is a life of impatient churning. They treat the stock market like a casino. They are constantly looking for the next hot tip, the stock that's going to be a 10-bagger overnight. They buy a stock, and if it doesn't go up in 2 weeks, they sell it and jump to the next thing. This constant activity, this churning, is poison for several reasons. First, it racks up enormous transaction costs. Every time you buy or sell, you are paying a broker, even if it's commission-free, through the bid-ask spread. Second, it's a tax nightmare. By selling stocks you've held for less than a year, you are paying short-term capital gains taxes, which are taxed at your much higher ordinary income tax rate, instead of the preferential long-term capital gains rate. You are voluntarily giving a huge chunk of your potential returns to the government. But the biggest cost of churning is that you never, ever allow compounding to work its magic. You are constantly pulling up your seedlings to see if the roots are growing. A wonderful business needs time to grow, to reinvest its earnings, to expand its moat. The impatient investor never experiences this. They might get lucky and catch a few fast winners, but over the long run, their frantic activity is almost guaranteed to lead to underperformance. They are all motion and no progress. This mindset is a direct result of our modern culture of instant gratification. We want our news in 140 characters, our entertainment in 30-second videos, and our food delivered in 20 minutes. We have lost the capacity for patience. We have forgotten that anything truly worthwhile, whether it's building a business, mastering a skill, or accumulating a fortune, takes time. The 99% apply their consumer mindset to the world of investing, and the results are predictably disastrous. They are playing a loser's game, a game of high costs, high taxes, and high stress, all while sacrificing the single most powerful force for wealth creation that exists. The direct financial connection of embracing patience is the staggering, almost unbelievable math of long-term, uninterrupted compounding. Let's end with a simple but powerful quantification. Imagine a 25-year-old invests $10,000 one time and never adds another penny. Let's assume it earns a 10% average annual return, the historical average of the S&P 500. By the time they are 35, that $10,000 has grown to about $25,900. A decent return, but not life-changing. By age 45, it's worth $67,275. By age 55, it's $174,494. And by the time they retire at age 65, that single one-time investment of $10,000 has grown to $452,592. Notice how the numbers accelerate. In the first 10 years, it earned about $16,000. In the last 10 years, from age 55 to 65, it earned over $278,000. The money it earned in the last decade of its journey was more than 10 times the money it earned in the first decade. This is the whole secret. The entire game of investing comes down to one thing: surviving long enough to reach those final, explosive decades of growth. Every rule we have discussed today, the absolute rejection of leverage, the avoidance of ruinous risk, the construction of a fortress balance sheet, is designed to do just one thing: ensure that you stay in the game. That you are not knocked out in year 7 or year 17 by a margin call or a life crisis. The single promise you must make to yourself, the final promise for a life of financial security, is that you will do whatever it takes to protect your capital so that it can live long enough to experience the full, breathtaking power of the compounding curve. That is the only leverage you will ever need. You have just invested a significant amount of your most valuable asset, your time, into understanding the single most powerful rule for financial survival. You now possess the foundational principle of capital preservation, the unbreakable law of avoiding leverage that separates the financially immortal from the temporarily rich. You understand not just what the rule is, but the deep psychological and mathematical reasons why it is the bedrock of all lasting wealth. You have acquired a powerful shield. But understanding this, rule is only the first line of defense in the Buffett-monger system of avoiding losses. This principle of avoiding leverage is the shield. It protects you from catastrophic error. But a shield is useless without a sword. The next principle is about how to actively hunt for opportunities that others, crippled by their own bad decisions and forced into panic by their use of leverage, are forced to abandon. The video on your screen right now is that next piece of the map. It's the link between defense and offense. It explains the mental model Buffett uses to turn widespread fear, the very fear created by the collapse of leverage speculators, into generational wealth. It's the bridge from financial survival to financial dominance. You've proven you're serious about your financial education by finishing this deep analysis. Most people don't have that level of financial discipline. The question is, are you content with just surviving, or are you ready to learn how to thrive? The choice to continue your ascent, to complete your mental arsenal, is right there on the screen. Click and continue the journey.